Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm here to help you make the most of your mineral rights and royalties. Justin Williams is here, as always, to help provide the individual mineral owner perspective. Hey, Justin.
Hey, Matt. Thanks for having me, as always.
Thank you for your time as well. And today we're going to have something a little bit different. This is a bonus episode that we're putting out to help you understand what's going on with the oil and gas market right now, with all the recent turmoil that's been happening over the past few days. When we're recording this, it's March 11th. And we want to talk about what's going on, give you the breakdown in terms of the timeline of events, what some of the experts are saying, and then our take on what the impact is going to be on the market for mineral rights and royalties, as well as kind of what to expect going forward from a oil price and gas price point of view. So, Justin, why don't you go ahead and just break down for us sort of what's happened over the past few days? It kind of all starts back to our March 2020 news episode where we talk a little bit about the effects of the coronavirus outbreak on oil demand, but what happened over the past week or so?
Yeah, let's do it. Let's dive in here. So, the effects of the coronavirus outbreak on oil demand seen early in 2020, IEA and the EIA revised the price forecast down. See the article in our March 2020 news episode to kind of reference back to that. It decreased the demand for oil and gas due to the decrease in the economic activity as a result of quarantines, lack of traveling, and all that good stuff. OPEC ministers tried to force Russia to join them in production cuts of 1.5 million barrels a day as a response to the coronavirus impacts on demand. OPEC held a meeting on March 6th. OPEC and its allies have failed to reach an agreement to extend curbs in the crude oil production. Told Russia if they didn't join them in cuts, the OPEC would abandon the cuts altogether. Russia did not agree. Saudi Arabia slashed crude prices over the weekend, targeting potential buyers of Russian oil. Both Russia and Saudi Arabia both pledged to increase production in the near future. Oil markets in turmoil, and oil dropped the most in almost 30 years on Monday, March 9th, the biggest drop since the 1991 Gulf War. Saudi Arabia on Tuesday, 3/10, pledged to raise its April crude oil production to record levels to put additional pressure on Russia and U.S. shale producers. Russia responded with their energy ministry calling a meeting with Russian oil companies on Wednesday, March 11th to discuss future cooperation with OPEC. Russia left the door open for future agreement with OPEC, but also said that they could raise output by as much as 500,000 in the near future. So that's a lot to happen there, Matt, in just a few days.
It is a lot that has gone on. And I think you've probably seen a lot of other folks in the industry saying this is a trade war that we're in right now. And make no mistake, I think that's absolutely right. Whether it was Saudi Arabia or Russia that fired the first shot, one of the knock-on effects is that in addition to both of them trying to regain market share, is they are trying to put U.S. shale producers out of business. So in trying to recapture that market share. And this is, something that we can't just stand by and hope for the best. I think that they're going to keep doing what they're saying they're going to do and increasing production in April. It's going to cause oil prices to plummet even further. And right now, as we're recording this, the price of crude oil is around $33 a barrel for West Texas Intermediate. Saudi Arabia is still saying they're going to flood the oil market. And I think what they're hoping is that they're going to put the U.S. shale producers out of business. We'll shut in wells, price will recover. And then going forward, they'll have recovered some of that market share that they've lost over the past few years to the U.S. So yeah, make no mistake, this is an all-out trade war that we're in. So Justin, can you talk a little bit about what some of the experts are saying that is going on as well?
Absolutely. So if you watch any of the news outlets, you may have heard of Goldman Sachs' letter on March 8th. OPEC and Russia started an oil price war, as Matt mentioned, and it could push the crude oil prices to $20 a barrel, according to Goldman Sachs. Goldman wrote in this letter, "We believe the OPEC and Russia oil price war unequivocally started this weekend," they said. The prognosis for the oil market is even more dire than in November of 2014, when price war last started, as it comes to a head with significant collapse in oil demand due to the coronavirus. IHS is saying that oil demand could fall by the most in history by as much as 3.8 million barrels a day in the first quarter of 2020, when it fell by 3.6 million barrels a day, and would be the largest contraction in history according to the IHS market. This is a sudden instant demand shock, and the scale of the decline is unprecedented, said Jeb Buckard, who is the IHS market head of oil markets. Attribute most of the drop due to stoppage in Chinese economic activity, but they expect demand to also be down globally, lower oil demand in 2020 as compared to 2019. And as we mentioned in our last show, Matt, some of it had to do with it being a warmer winter than expected.
That's absolutely right. So it's a perfect storm of conditions that we're facing right now. This sharp decrease in demand, partially due to the coronavirus and other factors, is being challenged by an increase in supply despite that decrease in demand. And again, the standoff between the Saudis and the Russians. I think long term, what they're hoping is that they can weather this for a certain period of time. They're hoping that they can regain some of that market share from the U.S. It's just kind of ridiculous when you think about logic and macroeconomics, and obviously they're not following the playbook there. They've thrown that out and sort of are doing their own thing and have their own agenda. Now, what this means for the U.S. oil and gas companies, what we saw in the 1990s with crude oil prices that were depressed for a decade. When I started work in the industry in 1999, the price of crude was around $18 a barrel. It floated between the teens and the 20s, and then maybe into the lower $30 per barrel for a decade. It didn't really recover until mid 2000s. And the difference between what happened in the 1990s and early 2000s and now is, back then we were dealing with mostly conventional oil and gas production in the US, and it was cheaper to drill and cheaper to operate those. And now what we have is an inventory of unconventional oil and gas wells with higher operating costs. And so this is going to put more pressure on operators to be able to stay in business. And what the reality of the situation is oil and gas companies are losing money at current oil prices. And even though some will say that they're cutting spending to try to stay within their cash flow. For example, Oxy said in 2019 investor presentation that even with their hedging program, their 2020 break-even price is in the low $40 WTI range. And they came out yesterday actually and said that they're reducing their dividend and slashing capital even further due to what happened over the weekend. And what Vicky Hollub said is the sharp decline in global commodity prices. And she also said that these actions lower our cash flow break-even level to the low 30s WTI, excluding the benefit of our hedges. And you have another company that really was kind of the leader. So Diamondback Energy was one that came out first to say that they were cutting spending to try to stay within cash flow. We saw several other operators follow suit. And I think what is happening is the boards at these companies are realizing that's really the only way that they will be able to survive. And what I think will happen to the U.S. shale producers at these low prices, we'll take a look at Diamondback specifically. According to their latest investor presentation, their before tax unit operating costs were around $24 per BOE. And that includes lease operating expenses, transportation, overhead, depreciation, and interest expense for their debt. And it excludes the production and ad valorem tax, or 7% or so, of which would be factored into whatever revenue they make. And their guidance originally was around 310 to 325,000 BOE per day. And assuming they only produced 300,000 BOE per day, so below that range, and assuming the price of oil is $25 a barrel, they have an additional expense of around $1.75 a BOE in just the tax. And so they're looking at, if you believe what they say in their investor presentation, around $26 a BOE. So between Oxy, Diamondback in the say upper 20s to low 30s break even price, that anything below that, they're actually going to be losing money if they produce. So, so if you're optimistic and say prices are going to be above this, then that those marginal barrels that they're producing, just without, again, this is not bringing any new production on, just producing existing wells, they're okay. Again, if they could pay their debt, they cut dividends, that they're able to weather the storm. Now, if prices fall below that, so if what Saudis are saying they're going to do in increasing production, decreasing their price by $6 to $8 a barrel, then we're going to be below those break-even prices. And, again, this is excluding hedges. So companies that have hedged for 2020, a significant portion of their production should be okay for the short term, at least, through time where those hedges are in place before they roll off. Once those hedges start to roll off, that becomes a big problem. So what we may be seeing is just a delaying of the inevitable. So if we see prices stay depressed into 2021, then those companies that, even though they may have hedged in 2020, they're going to be in real financial peril, and they're going to end up having to declare bankruptcy as well. So in the short term, I think what we're going to see, companies that aren't hedged, that have a significant amount of debt, we're going to see a series of bankruptcies this year, and those weaker, smaller companies. In the long term, if companies that, even if they are significantly hedged for 2020, if this low price environment in the $20 a barrel range, $30 a barrel range extends into 2021, we'll see another wave of bankruptcies. Now, again, like I mentioned at the beginning, when I started in the industry in June of '99, average price was $18 a barrel, and it stayed low for a decade. So we could be in a similar situation where low prices prevail for the foreseeable future. And I hope I'm wrong, and that the global economy bounces back from the coronavirus, that becomes something in our rearview mirror. But what's going to be required, I think, is that globally we need to bring production down below where the current demand is in order for prices to recover. And there's really no end in sight for that with what the Saudis and Russians are talking about. So the question that you're probably asking is, what does this mean for the market for mineral rights and royalties? I think one way that we can look back to what happened in recent times is look at what happened in the downturn in 2015. And in 2015, the fundamentals of the U.S. economy, they were good. There was pressure on the oil market due to the strong dollar. So as many of you know, when commodity prices, because they're tied to dollars, those actually fall when the US dollar goes up. So what we've talked about today is sort of deja vu all over again. So in 2015, OPEC wouldn't cut production to stabilize prices. In the meantime, US oil producers were trying to capture market share, and they were increasing production to over 9.3 million barrels per day. This is in 2015. You had the global economy that was weakening, China and Europe specifically. And then you had an increase in production from Iran due to reduction in Western sanctions. So similar story, increase in production, decrease in demand. And what we saw in 2015 was lower oil prices. Now you fast forward to today, the US economy is good, the dollar is strong, OPEC is refusing to cut production, global economy is under pressure this time due to the coronavirus. And then you have the Saudis and Russians this time increasing production. All the while, at least up until the past few days, US producers saying that they were going to keep production flat or would even grow slightly. So I think unless something changes with the Saudis and the Russians coming to an agreement, then what we're going to see is the US is going to have to fill the role of decreasing production in order to restore prices. And, it's sort of like a take one for the team scenario. So I think really what's going to end up happening is they're going to be faced with the decision to have to shut in production in order to stay in business. If it's actually more expensive to produce than it would be to shut in terms of what they're selling oil for. So I would expect to see oil prices depressed for the foreseeable future. I think what we would need to see is a significant cut from OPEC and U.S. shale producers, and then along again with a decline in coronavirus cases and resumption of normal economic activity before we see oil trade higher than in that $20 to say $40 range. Now, like I mentioned earlier, this is going to put a lot of financial pressure on operators, and especially those that are highly leveraged. Like we talked about in 2019, there were already companies that were under pressure when oil was at $50 a barrel. And so now what we're seeing is only companies that have a strong balance sheet, that are making the right moves in terms of cutting production, cutting any additional investment, just using their cash flow to pay down their debt, reducing dividends in the short term. Those are the companies that are gonna stay alive. Those that have a lot of debt and that are having a hard time making required debt payments at the oil prices, if they're not hedged, are in serious trouble. And part of the reason is because any sort of lending to these companies has dried up. The liquidity in the market is virtually gone in terms of banks willing to lend money to producers that are looking to refinance their debt. From where they're standing, it's like throwing good money after bad. So even companies that have hedged production for 2020, and like I mentioned, again, have that debt coming due in 2021, are going to feel the same pain if we don't see an uptick in oil prices. The reason for this, because if the price of oil stays depressed through 2020 and they're having to hedge production going forward into 2021 and beyond, they're going to have to do so at lower prices based on where oil is trading in 2020. So it probably wouldn't make sense for them to do that because they would be hopeful that the price would recover. Otherwise, they're locking in barrels at lower prices. So again, like I mentioned earlier, I think we're going to see some small operators go bankrupt in 2020. Next big wave coming in 2021, unless the market recovers by then. Now, the one caveat to that is if private equity comes in and saves the day. So it could be that some of these companies that have good assets, they have a good position in a good basin, you could see private equity come in and look to pay off that debt and get in exchange for an investment in that company. Now, if they do that, then that, what I just said would sort of potentially not play out fully. So some of the better companies might get saved if they have some private equity money that comes in. I think what you're going to see too, though, is the large integrated oil and gas companies being able to weather the storm better, because if they have refining divisions and chemicals, those are going to be profitable at lower oil prices because their feedstock costs are lower. And so that'll offset some of the losses that they're going to have with their exploration and production division. And so those companies will be better off, so to speak. And, potentially companies with a strong balance sheet or some of these larger integrated oil and gas companies could come in and there'll be some consolidation with them gobbling up some of their weaker competitors. Now, the silver lining to all this, if you do see across the board the continuation of companies saying they're going to slash their capital budgets this year, stop drilling new wells in these oil basins, this means that there's going to be less associated natural gas that would be produced. And associated gas is basically the natural gas that's produced as a byproduct of crude oil production. And Goldman Sachs came out and said, led by Brian Singer, we estimate if our cover producers invest on the basis of $30 to $45 a barrel West Texas Intermediate over the next 5 quarters, we'll see more than 1 BCF a day net less U.S. gas production. So we'll see a reduction in U.S. gas production of 1 BCF a day. And that prospect of companies cutting their budgets has played out a little bit in terms of the sentiment for oil and gas. And so natural gas prices were at one point as low as $1.61. But the April NYMEX futures contract was up 7 cents on the day to settle at about 178. This was as of Monday when the price of oil was tanking. And this optimism has continued for at least the time of this report. The price of Henry Hub natural gas was up another almost 5% to around $1.91. So this is, what you look at face value seem to be kind of contrary to logic if supply and demand is where it's at. But there's actually a silver lining from a supply standpoint in that drilling fewer oil wells is going to mean less gas is produced. And so this will help operators in the gas centric plays like the Marcellus and Utica on the East Coast and Pennsylvania, West Virginia, and Ohio, and then the Haynesville in Louisiana. And so I think what you're going to see is this helping the gas price, at least in the short term. We'll see how it plays out. But that's sort of, I guess, the silver lining to all this. Justin, I've been talking a lot. You want to talk a little bit about what you see from your point of view, from all that we've talked about in the past. When you look at the value of mineral rights, can you talk a little bit about how this might affect that?
No, absolutely. And I think, from a mineral right owner's perspective, it's just a little bit scary. We don't know exactly what's going to happen or what we'll end up seeing. But, the big question that comes to my mind is, well, will the wells that are producing continue producing? And I think you answer that in saying that as long as the price can hold out just enough that they can make money from operating them, then we'll be okay. However, the chance is always there for them to become shut in because it's no longer profitable to produce. Another thing I hear and I think in the back of my head is it's not a good time to consider selling minerals because the prices are going to be way down and anyone buying is looking to get those at a discount with the hope that in the future the market will be back up. And I think from a mineral right perspective, it's just kind of watching the news and waiting to see what happens and hoping for the best.
Yeah, I think it's one of those things you plan for the worst and hope for the best. Like you mentioned, you don't want to sell right now unless you absolutely have to. If you're going to invest in minerals, now might be a good time to buy. If you can buy in a good basin under a good operator, maybe they have some contract commitments that they're obligated to produce a certain amount and sell a certain amount into a pipeline. Well, they may end up actually contrary to what you would think they would do. They may actually continue to drill a few of those wells and complete those wells just so they can meet their contract obligations because maybe it's cheaper to do that and take a small loss in drilling those wells than it would be to have to buy gas or oil on the spot market just to fulfill those contract obligations. So there'll still be probably a little bit of activity in some areas where that is the case. And if you happen to be in that situation where you're looking at a property that is got a rig on it and the operator's saying they're still running a completion crew, they're just running a minimal amount to meet those obligations, and you can figure out that might be in an area where you're looking to invest, and that would be a potential opportunity. So there'll be a few opportunities out there where there's some near-term activity. The other side of it is if you're willing to weather the storm, if you have a little bit of cash and can invest in some of these good basins, people that need to sell, you might be able to get a pretty good deal. And I think we were starting to see that in the market before all of this went down, that investors were really looking for deals to be had where they were expecting to still get a return on their investment. The price of oil being down, they could pay based on a lower valuation. So that is something to take into consideration. Again, I think it becomes really important to take a hard look at who the operator is under whatever property you're looking at, because that operator health is going to be important as to whether or not they're going to be able to do anything with that acreage in the foreseeable future. So yeah, that's something to take into account as well.
Absolutely. Well, and like we've talked about many times before, in situations like this, it just shakes those small operators out and leaves the big players or the players who are going to survive and are really watching their balance sheet and keeping up with what's going on. So it'll be interesting to see how the market comes out. What's kind of your gut feeling, Matt, on what you think? I know it's hard to say, but do you see the oil prices being down for an extended period of time?
I would definitely say through 2020, probably into 2021, depending on the severity of what's going on right now with this coronavirus and how severely it impacts the global economy, it could be that we're into a low price environment until that recovers. And it doesn't happen overnight. In the meantime, it depends too on how serious the Saudis and the Russians are on putting the squeeze on the US. And if they're serious about what they say they're going to do and actually continue production, then we could be in for a low price environment for a while. Again, I hope I'm wrong. I hope prices do come back sooner. But I think from a planning standpoint, like I said just a minute ago, you got to plan for the worst and hope for the best. So I think planning for a low price environment, again, if you're looking to invest, it could be the next year or two or a good time to get into the market for minerals and royalties. Again, you're buying at a low price. And, so long as you're valuing the assets at that low strip price, then you should be okay. So yeah, not buying opportunity. Again, buyer's market, definitely not a time to sell unless you're absolutely needing to. Be best to just hold on and weather the storm. And like I said, hope for the best, but plan for the worst.
That's right.
Well, that wraps up this bonus episode we have with a little bit of a oil and gas market update. Hopefully this has been helpful in providing some food for thought. And we'll have links to some of these articles that we've referenced so you can read more. And, just stay tuned to the Mineral Rights Podcast. Be sure to subscribe so you don't miss out on any future updates. We'll try to keep up with what's going on and come back out with an update. If not in our normal news cycle, then with an update episode. And also we have some great guests that are coming up here in the next month or so. Whether you're in the individual mineral owner point of view and looking for some tools to help you manage your royalties, or try to understand, like I was talking about, what activity might be going on, even despite what's going on in the market in your area. We have some companies that can help you with that. We've interviewed some amazing guests coming up, so be sure to subscribe so that you don't miss out. All right. Thanks again, Justin.
Thanks, Matt. Appreciate it.
Talk to you next time.
Talk to you then.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.